Welcome to the Deep Dive. Today we're really focusing in on Frequency Electronics, Inc. That's SBIM. We're going to unpack their recent Q1 fiscal year 2026 earnings call. It came out after hours, September 11th.
Yeah, and this one's interesting because, you've got this real disconnect. The CEO sounded super bullish, painting this big strategic picture of future growth.
Right, the long-term story.
Exactly. But then, bam, the market just tanks immediately after the numbers hit. So that's what we need to figure out for you.
Was it panic? Or did the market miss something deeper? Let's start with the top line, the results themselves, because, well, that's where the trouble seemed to start.
Definitely.
Q1 revenue was $13.8 million. That's down almost 9% year over year. And crucially, it missed the street's expectation of $16.5 million. Missed it by quite a bit.
A big miss, yeah. And when revenue misses like that, the bottom line feels it too. GAAP earnings per share, well, it just cratered. Down to $0.07.
Only 7 cents, compared to $0.25 last year. Ouch.
Exactly. So the market signal was, let's say, pretty unambiguous. The stock dropped, nearly 10% after hours? Investors were clearly not happy with the short-term picture.
Okay, so that's the initial hit. Pretty bad news. But you listen to the call, management didn't sound like they were panicking.
Not at all. They jumped right in to frame it, said it was basically a blip. A timing issue, that was the key phrase, not a fundamental demand problem.
Okay, timing. What did they blame the timing on specifically?
Two things, mainly. First, they said customers pushed some programs back, caused delays. Second, they apparently pulled some revenue forward into the previous quarter, Q4 of fiscal 25.
So that made Q4 look better, maybe, but hurt Q1.
Could be part of it.
Yeah.
And the CEO was really emphatic here. He said, and I'm quoting loosely, these were neither cancellations nor contract reductions. Very clear on that.
So no lost business, just pushed out.
Right. And even better, from their perspective, they hinted that at least one of these delayed programs might actually get bigger. Expanded significantly was the phrase used.
Okay, bold claims. If they're so confident this is just about when the revenue hits, not if, did they point to anything concrete right now to back that up? Besides the backlog, I mean.
Well, yeah, you have to look a bit deeper than the revenue line, sort of into the balance sheet mechanics. That's where you see what they call the green shoots.
Green shoots? Okay, like what?
Cash flow from operations. It actually flipped positive, went from minus $1.5 million last year to plus $1.2 million this quarter.
Okay. So even with lower revenue, they managed cash better.
Seems like it. Shows maybe some operational tightening. And the other big thing, maybe more of a signal to the market, was the new share buyback.
The repurchase authorization. How big?
$20 million. $20 million. That's not pocket change for a company this size. It's basically management saying, hey, we think our stock's cheap right now after this drop, using company cash to back that belief.
Okay, that $20 million buyback is a strong signal, but I'm still stuck on the profitability. Gross margin fell. Let me check. 760 basis points. From 44.4% down to 36.8%. That's huge.
It is a big drop, no question.
And the explanation was mix of business activity. That sounds like, the standard excuse whenever margins drop. Was there more detail?
It's always a bit vague, isn't it? But the CFO did try to add some color. Essentially, they argued that their really profitable stuff comes from selling existing established products.
Manufacturing margins, basically.
Right. But this quarter, a bigger chunk of their work was apparently development efforts, new product stuff, integration, things that just naturally carry lower margins while they're getting ramped up.
And we can actually see that shift in the revenue breakdown they gave, can't we?
We can.
Commercial and satellite work, usually the high margin driver, that was down. Only 47% of revenue this quarter.
Yeah, $6.5 million.
While the non-space U.S. government and DoD business, maybe where that development work is happening, that was up. Hit 50% of revenue, or $6.9 million.
Exactly. So that shift in where the money came from seems to be the core reason for that overall margin compression.
Okay, so lower revenue, weaker margin mix. That explains the operating income drop, right? From $2.4 million last year down to just $1.4 million.
Precisely. But you also have to factor in the cost side. Specifically, SG&A.
Sales, general, and administrative. The overhead, basically. Let me guess, that went up.
It jumped. Went from 19% of revenue last year up to 26% this quarter.
26%. Wow, that's a big increase. Investors usually hate seeing SG&A spike like that. Do they justify it? Or is this just the cost of doing business going up?
They argued hard that it was strategic spending, not bloat. They pointed to specific things driving it up.
Okay, like what?
Primarily one-time, or at least front-loaded, costs tied to their growth plans. Things like the expansion into that new Colorado facility.
The Boulder site.
That's the one. Plus, specific investments in their quantum sensing work and hiring costs associated with bringing in senior people for those new initiatives. So they're basically saying they chose to spend now, take a hit on the P&L.
The profit and loss statement.
Right. Take that hit now to fund what they see as future growth drivers.
So, investing today for payoff tomorrow. A classic story.
And it helps that they can afford to do it. Their balance sheet, as they kept pointing out, is really clean. No debt.
Still debt-free. Okay.
Yeah, and about $30 million in working capital. So they have the financial cushion to handle this kind of quarterly swing and fund these investments. And importantly, that core demand signal, the funded backlog.
Did it hold up?
It actually edged up slightly, hit $71 million, which is still near historic highs for them. So the argument is, demand is there, the backlog proves it, it's just the timing of converting it that wobbled this quarter.
Right, that $71 million backlog is definitely the anchor for anyone bullish here. Okay, let's pivot then. Let's talk more about those future growth areas that are costing them money now. Quantum sensing and this PNT focus.
Yeah, PNT position, navigation, and timing. That's really their bread and butter, providing super precise, super secure timing signals, the kind of thing that runs critical defense systems, satellite networks.
It's master clocks, essentially.
Kind of, yeah. And the big strategic push, the one getting the investment dollars, is quantum sensing.
They talked a lot about that new engineering site in Boulder, Colorado. What's the significance there, beyond just adding space?
It's about talent, really. They made a point of saying they're hiring senior scientists, people who used to be at NIST's Time and Frequency Division.
NIST, National Institute of Standards and Technology. Okay, that's serious credibility.
It is. It signals they're serious about competing at the high end of this next-gen tech. They're not just dabbling.
So they're spending money, hiring top people. What's the expected return? Did they give any timeline for when this Boulder investment starts paying off?
They did, and this is a key date for investors to watch now. Management said they expect the Boulder facility to go from being a cost center to actually contributing positively to the P&L.
Making money, not just costing money.
Right. By Q3 of this current fiscal year 2026.
Q3 FY26. Okay, so that's what, maybe 6 months out or so?
Roughly, yeah. It puts a deadline on it. They also mentioned they're building the ecosystem around this, hosting their second quantum sensing summit in October, trying to position themselves as leaders.
Got it. And beyond the new quantum stuff, they did reassure on the existing business too, right? The core defense program.
Oh, yeah. They confirmed work continues across the big ones. Golden Dome, Patriot missile system, the B-2 bomber, the Ad missile defense. These are sticky, long-term programs.
Not things you easily lose.
Exactly. And they also mentioned they're bidding on new stuff, programs potentially larger than the typical contract wins they usually announce. So they're signaling ambition to scale up even more over the next decade.
And that ambition fits neatly into the bigger picture they painted, didn't it? This whole battle to protect time idea.
It does. They spent time talking about how vulnerable standard GPS timing is, pointing to news headlines about jamming, spoofing.
Like that incident with the European Commission president's plane having GPS issues.
Yeah, they cited that specifically. Their argument is the world sees the vulnerability, and we provide the resilient, secure, sovereign timing solutions that the defense customers increasingly need. It's a strong macro tailwind for them if they can execute.
And they gave some product timelines too in the Q&A, trying to show this advanced tech is actually moving towards reality.
Yes, some specifics there. They mentioned mercury ion atomic clock prototypes. They're working with JPL on those.
JPL, Jet Propulsion Labs.
Right.
Okay.
Yeah. The point is, these are aiming for much higher precision than current chip scale clocks, better accuracy, more resilient. They think low-rate production could be about a year away.
A year. Okay. What else?
They also mentioned NV diamond magnetometer prototypes. That's tech for alternative navigation, stuff that doesn't rely on GPS. Prototypes for customer testing expected by the middle of next calendar year.
So, concrete steps, moving tech from the lab bench towards actual products.
That's the message they want you to hear, definitely.
Okay, so putting it all together, it's this stark contrast, isn't it? Management saying, the worst is behind us, full steam ahead, while the market reaction was basically, we don't believe you, chopping 10% off the stock. How do we make sense of that gap? What's the real takeaway here?
I think the market's basically saying, show me the money. Look, This stock had a monster run over the past year, right? Up well over 100%, maybe closer to 170% at its peak.
Yeah, huge performance.
A lot of that run was likely fueled by excitement about the big backlog, the quantum potential, the narrative. This earnings miss, even if it's just timing, seems to have been the trigger for the market to say, okay, narrative time is over, now we need execution.
Execution meaning actual revenue coming in, actual margin stability.
Exactly. Concrete results, not just promises. The sell-off suggests the market's patience for rewarding potential just ran out. Now it demands proof. The divergence is huge, but you still have that $71 million backlog underpinning things.
So if you're watching saying now, what are the absolute key things you need to track to see if management's story holds up? What are the critical metrics?
Okay, I'd say three main things. First, timing resolution. Did those delayed programs actually catch up? We need to see proof that the revenue lands predominantly in this fiscal year, like they promised. Any hint of further slips into FY27 would be bad news.
Makes sense. What's second?
Second, margin normalization. Was that big gross margin dip really just about temporary mix, or are higher costs, especially that increased SG&A, becoming permanent? We need to see gross margins start climbing back towards that mid-40s range they used to hit.
Right. Prove the profitability engine isn't broken. And third,
The big one, that Q3 FY26 quantum P&L milestone. That Boulder facility has to start contributing positively by then, as they guided. Investors will need to see real bookings, real revenue coming out of that quantum initiative to believe the investment thesis. That's the major catalyst or potential disappointment looming.
okay, timing, margins, and the Q3 quantum proof point.
Got it.
Now, let's shift gears. This is the part where we put on our imaginary hedge fund analyst hat. Remember, everyone, this is absolutely not financial advice, just a thought experiment based on the call. What's a potential trade idea here?
All right, let's call this the catalyst bet on quantum recovery. The premise is simple. The market massively overreacted. It got laser focused on the Q1 timing miss, the margin dip, and basically ignored everything else.
Ignored the $20 million buyback, providing a potential floor.
Right.
Ignore the strategic value building in quantum.
Exactly. Ignored the fact that management put a hard deadline just 2 quarters away on when that quantum investment is supposed to start generating positive P&L contribution. The market priced in the short-term pain, but maybe ignored the potential near-term gain.
Okay, so if you buy that premise that the market is being short-sighted, what's the specific trade structure you'd consider?
You'd want to play for that Q3 catalyst. So maybe initiate a synthetic long position. Buying long-dated call options, specifically targeting an expiration date after that Q3 FY26 earnings report would likely come out.
So bidding on positive news around Q3.
Precisely. The bet is that management is right. The bet is that those delayed programs do catch up in the next couple of quarters, that the $71 million backlog starts converting smoothly, and that the Boulder quantum facility delivers that P&L contribution on schedule by Q3.
And if all that happens,
If that happens, then the stock, which just got hammered almost 10% on what management swears are just temporary timing issues, could re-rate violently upwards. Back towards those recent highs, it's fundamentally a bet against the market's current pessimism and for management's ability to execute on this defense and quantum roadmap over the next, say, 6 to 9 months. High risk, high potential reward.
a bold bet on execution for sure. Okay, let's wrap this deep dive up. Key themes from Fame's Q1 call. A headline miss driven by timing and investment spend, not apparently a drop in demand. The core defense work looks solid, Golden Dome, DAID, etc. But the real focus now is on delivering on that high-stakes quantum bet coming out of the new Boulder facility.
Right. And the big question we leave you with is this. Considering the stock's huge run-up before this, was that nearly 10% drop an overreaction to a temporary blip? Or was it a necessary reality check, the market finally demanding proof after months of buying the story? The next 6 months are critical. It all comes down to seeing those delayed contracts hit the books and seeing real results from Boulder.
Thank you for joining us for this deep dive. We'll keep tracking how this story unfolds.